All right. Good afternoon, everyone. Thank you for joining us today for the August edition of the Ohio Workforce Coalition's monthly webinar. Again, thank you for joining. If you are on the phone, please go ahead and mute yourself. We welcome you to be on camera or off camera. If you have a question, please feel free to either enter it into the chat or use the raise your hand function. We are recording, and you'll be able to get that online as on the Ohio Workforce Coalition webinar. And before that, I want to say just a few words about the coalition. So the Ohio Workforce Coalition has been around since 2007 and has been bringing together workforce stakeholders from across Ohio who cover a wide range of topics. We work to build networks, engage participants in those networks around public policy, and then make policy recommendations and advocate for them. You can find our most recent policy recommendations on our website, and I will also post them in the chat. We cover a wide variety of topics, as I mentioned, and our last webinar featured really a conversation with an executive from Ohio Health. We decided with this session to continue along, and actually at our guest's recommendation to continue along with a conversational format. So we are going to do that to learn about income share agreements. And again, we've got some new folks on the webinar today, so hopefully this is a topic that interests a wider audience of people. And with that, I think we will go ahead and get started. So Ethan Pollack, who is joining us today, has been doing a lot of work on the future of financing post-secondary education across the country. And we are excited to have him here because the idea of alternative financing mechanisms is important to both innovation in the field as well as to work that's already happening. Ethan has been with the JFF and leads their Financing the Future, Jobs for the Future, and leads the Financing the Future of Work initiative. And before that was doing similar work at the Aspen Institute, and earlier worked with the Economic Policy Institute. He's spent a great deal of time thinking about these financing mechanisms and how they can expand access, affordability, accountability, and equity in post-secondary education and training. This was an important topic for me because as the coalition considers the future of workforce development, what opportunities there are for innovation, and how to ensure an equitable recovery, it's important for us to understand what else is out there. If you are just joining us, please go ahead and feel free to introduce yourself in the chat. You can also use the raise your hand function to ask questions throughout today's session, or feel free to enter those into the chat. But I want to go ahead and get started and ask Ethan to say a bit more about how you became an expert in alternative financing tools. What drew you into that space?
Yeah, certainly. And first off, just thank you so much for inviting me here to speak, and also so excited that there's so many people that are interested in this topic. This is such an emerging and exciting topic, so I'm always super stoked to see people engaging in it. So I came into this pretty accidentally. To be perfectly honest, I was working at the Aspen Institute Future Work Initiative for about 5 years or so. And over that time, there was this large conversation around the future of work and around kind of like, the skill demands changing and automation and, the gig economy and all of that. And, I really kind of came to the belief that for a variety of reasons, but one being kind of what I was focused on then, which is these future of work challenges, we really needed, and we totally currently lack, a really strong skills training universal, lifelong learning system in this country. And in particular for the future of work, jobs will continue to be changing as a result of technology. For some people, they'll need to be adapting to that change on the job. They'll need to be working with technology on the job, or there may be job technology that replaces them. For some people, they may be displaced from their work and need to retrain to new jobs. The common thread throughout all of that is that workers need access to high quality, affordable, and accessible skills training. And we just don't really have a great system to really solve that. We have a few systems that are kind of like, that solve similar things to that or adjacent things. The higher ed system is very well built out, but it's not directly engineered, designed for that problem. We have a workforce development system that's fairly underfunded, but could potentially be the foundation for that. But ultimately, I really felt, we need a better lifelong learning system. And I should add also, employers oftentimes are the ones that are usually training their workers, but there's also been kind of a decline in employer training over this time. So, I really saw income share agreements as one potential way to create a system. It could be kind of the engine behind a system that is really more affordable, higher quality, and accessible to everyone, and that potentially also then unlocks a lot of money, either philanthropic dollars or stretches workforce dollars, or potentially even unlocking private sector dollars. So I think there's a little more dangers with that we need to be really clear-eyed about. But really saw ISAs as potentially transformative. Coming to I'll say when I was at Aspen, I also felt like the conversation around ISAs was really polarized, and unfortunately so. I kept going to these conferences where you had all of these people that were saying ISAs are amazing, it's the best thing since sliced bread. And then I went to all these other conferences where people were like, this is horrible, this is indentured servitude. And I felt so frustrated by that, because I felt like there was a lot of good points that both sides were making, and they were just totally talking past each other. So the last year of my time at Aspen, put together a one-year initiative that really tried to bridge that dialogue and to get all of the different sides talking to each other and to come to some sort of kind of consensus around what some best practices were for a student-centered and equity-centered ISA, and then also some kind of like recommendations around policy as well, both at the federal and state level. And that really then built onto my work at Jobs for the Future. So I now run, as Rebecca mentioned, I run Financing the Future, is a relatively new initiative. And our focus is not just on ISAs. Well, ISAs are just one of many innovative finance tools that I think really have the potential for systems transformation. So ISAs are one, but that also includes things like merit-based lending, which are traditional loans, but use outcome data to do the underwriting, or deferred tuition agreements, which are very similar to ISAs. But then also things like pay for success, which is not a financial instrument at all, but rather, the contractual relationship between kind of a government and a service provider, or lifelong learning accounts, employer incentives, employment-based training. I mean, I think all of these things have the potential to really shift the costs and the risks away from students, and in many cases doing so by aligning the school's incentives with the student outcomes. So that's really kind of what's drawn me first to ISAs and now to this broader family of innovative finance. I'll focus mostly on ISAs here because I think that's kind of the topic at hand, but I just wanted to kind of flag that kind of the family here is a little greater than just ISAs, although I do think that ISAs offer some of the highest potential in the space. Oh, Rebecca, I think I'm mute.
Thank you. I thought I unmuted myself. That's helpful and certainly puts ISAs into a broader context of kind of emerging ideas. Could you say more about how ISAs are intended to work and what makes up kind of the key components of one?
Certainly. So ISAs are a financial obligation, a contract that's signed between the ISA provider and the student. So the ISA provider can be a few different entities. Oftentimes we think about it in the context of the school itself. So the school is offering an ISA to the student, and then the student has an obligation to repay the school, sometimes in lieu of either a portion or all of the tuition that they're paying. It may also be a third party. So there are some ISA lenders that lend to students that are at different institutions, usually different terms for each institution. But ultimately, that's basically a third-party lender that oftentimes has relationships with the school itself as well, but not always. There have been some examples now of kind of workforce boards. San Diego Workforce Partnership, which is an example we can get into a little later, but they are offering ISAs as well. And New York City Economic Development Corporation is about to offer an ISA. So you're starting to see kind of like that family of providers grow from just the school to now kind of third party, and then workforce board and Economic Development Corporation. So that's kind of exciting, and the ISAs kind of operate a little differently in those different contexts. But what kind of makes up an ISA itself? That the actual kind of definition would be really a couple things. So one is that there is a threshold. If a student, once the student graduates or drops out, hopefully not drops out, then afterwards, if they only make any payments if they make above a certain threshold, that's oftentimes somewhere between $30,000 to $50,000, but that can be actually as high as $70,000 to $100,000 for some of the schools that really think that the students are going to do well. But so if they make anything under that on a monthly basis, they don't make any payment. They still have to report their income, but that's it. They're not making any payment. It is only if they make above that certain threshold then they make payments. And if they make above that threshold, those payments are calculated as a percentage of their income rather than a fixed dollar amount. And what that does is that makes sure that the people that the students that make more money, those two kind of contract terms together ensure that students who make more money after graduation pay more back. And the students that, for whatever reason, don't make a lot of money, either because the education just wasn't a good fit for them, or because they graduated maybe during a recession, or they had to go and take care of some family members, or they just decided that they can just decide, I don't want to go into the field that I trained for, I want to go into a lower paying field, that they are going to pay less or maybe nothing at all. And so you get kind of the students that do really well then are in a sense kind of, you can think of as cross subsidizing the students that are not doing quite as well, and there's a certain level of risk transfer there. So there's the income share, there's the income threshold, and then there's the number of payments that they need to make. So one example could be an ISA would be $30,000. That's the threshold. The income share could be 5%, and then the number of payments could be the monthly equivalent of, let's say, 4 years. So I need to make 4 years worth of payments, which would be, I guess, 48 payments over the, but basically like, kind of like if I make below that, then I don't need to make any payment. There's usually also then an expiration. So it may be that I need to make kind of 48 payments over like 6 years. If at the end of those 6 years, I haven't made enough payments, the entire obligation ends. The analogy would be for a student loan, it's forgiveness. But in this case, there's really no principle to forgive. But so there's 3 stop conditions for this. One is I either make the required number of payments. It doesn't matter how much I've paid back. It just matters how many payments I've made. The second is then this time period. So there's a certain period of time after which the contract just expires. Again, no matter how much you've paid back. Or you can hit a cap. So for students that do really well, that make a lot of earnings after graduation, it is possible for them to hit a cap. That cap is usually defined as a multiple of the original amount that they financed. So that can be maybe 1.5x. So if the tuition that they financed with the ISA was $10,000, then as soon as they pay back $15,000, the contract ends. So those are kind of the 3 stop conditions. And ultimately, because of all of those factors, what you're doing is the person that's providing the ISA to the student is taking on a bunch of risk, because if the students don't do well, then that provider, whether that's the school or another provider, they're the ones that don't get paid back. And eventually these contracts end, even if as soon as a certain amount of time lapses, which means that there's a substantial amount of risk that the provider is taking on. But the flip side of that is that it's actually less risky for the students compared to something like a loan, where they need to make payments and they eventually need to pay back everything. Now, I know we have kind of IDR programs in the Title IV system, and that's fantastic. But this is kind of in some sense replicating that a bit, but outside of that system. I think you're on mute again.
I'm so sorry. I'm just going to leave myself off mute. I got a question in the chat asking where exactly the money comes from. Is it the school, something else? How does that work?
That's a good question. It entirely depends on the context. But I know for a lot of schools, because this is something that philanthropy is really interested in, a lot of schools, and certainly for also San Diego Workforce Partnership, they've relied heavily on philanthropic contributions to set up a lot of these. There is a private market for this, and there is private capital. So oftentimes a lot of boot camps are using ISAs. In fact, that's where kind of I think some of the initial excitement around the ISAs came about in. And for those, a lot of those are for profit. So there are a lot of private sector dollars that either own that school or are kind of making investments into an ISA fund that they're setting up. So it's kind of a mixture, I would say, between philanthropic and then also and philanthropic with kind of philanthropic grants, and then philanthropic kind of like impact investors that are expecting a return, but it may be they're happy with something that's below market rate, or actually kind of private market rate investors.
Thank you. And so that actually makes it sound that there's so many different directions that these could go. There's also a lot of potential, and we talked about the transformative potential in ISAs. Can you elaborate a bit about what you see or what opportunities you see?
Yeah. So yeah, I hear this question a lot of kind of like, what, both the transformative potential, but also just kind of like, well, what problems are we even trying to solve with ISAs, right? And I think it really depends on the context. So for the Title IV system, we already have a variety of kind of financial aid opportunities, but there are gaps there. So for example, federal financial aid is inaccessible to about 23 million individuals over 25 and older without a high school diploma, or 45,000 undocumented students, as well as the majority of adults who want to pursue non-degree training options or accelerated programs. A lot of people just don't have credit scores. A lot of people just, for one reason or another, just don't qualify for kind of the existing options. So, one thing that ISAs can do is really kind of close a lot of those gaps. Or it's for students who want to go into shorter term programs, or maybe unaccredited programs, right? So there's that kind of that second. So the first is kind of the Title IV system, where it's really about kind of filling in some of the existing gaps in the system, and it could potentially offer some transformative power. But where I really get excited about is less in the Title IV system and more in the non-Title IV system, more in kind of the area where we have kind of workforce development, skills training, non-degree programs that are really just designed to get people a job. And in this system, this is an area where there's not great regulation because it's outside of the accreditation system, the federal accreditation system. There's a lot of variation in terms of quality in these schools. And we've heard so many stories about a lot of, in particular for-profits, but sometimes nonprofits, that are not doing well by their students. I should add that exists in the Title IV space too. We saw a lot of those Wall Street Journal article about kind of the Columbia film master's program. So this is not something that's specific to the non-Title IV space, but nonetheless, I really think that ISAs can really make this market work better. That it can align incentives, that it can make sure that schools are only getting paid when the students do well. And we can get in a little bit later about exactly how to do that, because it really depends on how the ISA is designed. That doesn't happen automatically, but there is just such real potential to turn this kind of like this skills training market into one that is not where providers are not competing on the size of their advertising and marketing budget, which is, I think, oftentimes what happens now. But they're going to be competing on the basis purely of how well the students are doing. And they can't. This isn't going to be about like, are they overstating their outcomes or anything like that? Because ultimately, they get paid based on whether the students do well. And if the students don't do well, they're going to get paid less, and there's no way around that. And hardwiring that into the market is something that I am really excited about.
Great. Well, yeah, I mean, I can sense your energy. I've spent a lot of time in workforce development, and this sounds like almost too good to be true as far as, the set number of years and not having to pay after a certain amount and the threshold and whatnot. And I'll admit that when I first heard about ISAs, I was a bit uneasy because they were being pushed by a private school that was not really connected to other sources of or other parts of the workforce system. They're unregulated, they're new, so I didn't know a lot, which is one of the reasons we're doing this. And they, more funding for training is important, but what about supportive services and job readiness and and career coaching after employment, the whole sort of continuum of things people need. And so I'm sure you've heard that before. Would like to hear what you have to say about.
Good. How are you?
Oh, Brittany, I think you're off mute. Yeah, so I think that those are like not only just like valid concerns, but those are a lot of concerns that we should have kind of in our mind going forward. So, to add to that list, I mean, ISAs are, because they're a relatively new financial product, we need to be really careful about kind of how they're marketed to students, and also making sure that students actually understand these things. Students oftentimes don't even understand how student loans work, right? Like, student loans are really complicated. And this is kind of a new structure. Students oftentimes rely on kind of their family or community to understand more about kind of, some loan opportunities that they have. But, with ISAs, a lot of people around them may have no experience with ISAs. So we need to just be like really extra careful about how we go about this. I'm excited about ISAs, but I'm excited about the potential of ISAs. And I really want to underline that because it won't happen automatically. There are a variety of scenarios that we could go in. And there is one scenario, there is a path that ISAs could take where they're the new payday loans. And they are making things just a whole lot worse. That is if we do this wrong, but we can do this right. The analogy that I always think about is something like electricity. Electricity is really powerful and has done a lot to improve our living standards. But when people are first discovering kind of the dynamics of electricity and potentially considering ways to harness electricity, if you had come to someone and said like, okay, so this is a thing that if you touch it, it could kill you. And it's invisible mostly. What we're going to do is we're going to put it in every single room across the country, and we're going to put it at the level that infants could touch it. Everyone would freak out. And I'm glad that we didn't say, no. Electricity is just too dangerous. There's too much risk here. The fact is that electricity had a huge amount of risk. It's extremely dangerous, but we went about it in a way where we thought about we went about it clear-eyed with the risks. What are some of the best practices that we can use electricity? And then we also created a bunch of laws around, in particular around how homes can be built to make sure that electricity and, building codes to make sure that electricity is deployed in a way where it's benefiting society, but is not just like accidentally killing a whole bunch of people as well. And I see a similar thing here. ISAs have the potential they have a huge amount of potential power. But we're not going to realize that potential, the transformative potential on its own. And if we don't think about this in a careful way, very clear-eyed about a lot of the risks, then we can, I think it's going to be really a missed opportunity. So, yeah, I think that as I said, kind of, I got into this space in part because I had frustration that the sides weren't talking to each other. And in particular, I just felt like a lot of the ISA industry was so excited about ISAs that they were not really hearing a lot of the concerns. And I felt like it was really important to hear the concerns. I think that the ISA industry has moved a long ways, really matured towards really starting to think about those. And you're starting to see that some in how ISAs are really designed to really take into account a lot more of the concerns around consumer protections.
Fair enough. Appreciate that. That leads me actually to sort of a question about how do you make people aware of those caveats and things to be thinking about and looking at. Can you say more about what specific safeguards ISAs can or should have to protect individuals? from some of the potentially predatory practices? And are there specific things that policymakers or providers should be thinking about as they set them up?
Yeah, well, so I know that the ISA industry right now is working on kind of, what are some best practices. There's been some individual providers that have put out their kind of either kind of like Students' Bill of Rights or kind of like guidelines for student-centered ISA. When I was at Aspen Institute in my project, I put out my own set of kind of guidelines around how to operate an ISA. But I know that, as the industry is really maturing, it's starting to kind of coalesce around certain practices. And one is trying to figure out, what is a standardized disclosure form? Instead of having all these different disclosure forms, getting together with a few options and then actually field testing them and seeing actually what do students what leads to students really understanding this and what doesn't. You don't really know until you actually take it into the field. And so that's I think a very good development. In terms of policymakers, there's a lot that they can and I think should be doing. The policymakers at the state and federal level, they need to really intentionally regulate ISAs. Now, it's not true that ISAs are completely unregulated right now. So everyone agrees that ISAs are subject to many consumer protection regulations, including protections against unfair and fraudulent practices and things like that. So if an ISA is saying that it's going to do one thing in the marketing, but then it doesn't do that, everyone agrees that that's illegal. There are some open questions as to whether they are subject to things like the Truth in Lending Act, the Equal Credit Opportunity Act, et cetera, because they don't necessarily look like loans. So it's a question of like, well, is it a loan enough like product that it falls within this? And I'm not a lawyer, so I tend not to take a position on that. But I will say that I do think that right now there's a lot of ambiguity. There's a lot of uncertainty as to how they're regulated. And we shouldn't have that. we should have a system that is very clear about how they should be regulated. And I think that should happen at the state and federal level. So, when I say that they should be regulated intentionally, that sounds pretty basic, but if you ever worked in kind of politics and policy, you know that that's actually like a really big ask for policymakers to really actually be intentional about how they want to kind of like regulate a certain product. There's a couple ways that they could do this. One is that, they could, legislators or regulators could create an entirely new regulatory framework specifically designed for ISAs. Or if they believe that ISAs fall under existing loan regulations, they could just be really thoughtful about how those regulations should apply to ISAs. What we really don't want to have happen is that we don't want to have a bunch of enforcement actions that tell industry what not to do, but don't really spell out what to do. So it's really important that regardless of whether these are regulators or whether these are legislators, that they think through, that they take into account that ISAs look a little different than loans. For example, they don't have an interest rate. So like the regulation can't say disclose your interest rate or disclose your APR, right? Because all of the repayments are income contingent. So someone may be repaying a lot more than someone else. So you can't really, if you look at what an APR is, it's going to look like a range between kind of, somewhere in the negatives to extremely high if someone pays it back very quickly. That's not very helpful for consumers. So thinking very thoughtfully about what the framework is, whether it is them passing a new law or whether it is just reinterpreting how the existing protections should be. But what we really want is ultimately, I think JFF is very supportive of there being at some level strong guidance about how ISAs should be operated and what is legal and what is how we can do it in the best way to protect consumers.
It's going to be really interesting to see how that evolves. In the workforce field, we talk a lot about braiding funding and, you're pulling a little bit from here and there. And, it could be an interesting tool as sort of gap financing for training. So they may be more affordable than traditional loans, correct? And, there are a variety of other training sources out there. Those public training sources a lot of times are free. So even though ISAs are more affordable than traditional loans, they're obviously, still cost more than the free public training. Is there a potential that using an ISA could leave someone kind of worse off? Does that depend on, staff's familiarity with it and how they direct people? How do we avoid people taking out an ISA or signing an ISA instead of getting something they could have gotten for free?
Yeah, that's a great question. So I think there's two levels to that. One is at a systems level. How do we make sure that we are not displacing other forms of funding? We don't want ISAs to be there and then people say, cool, well, now we can reduce workforce expenditures because of it. I don't think that that's going to happen because workforce, funding is already fairly restricted anyway. And right now it's just a question of, how do we operate in the world that we have, right? How do we make the most use of constrained dollars? And at the level of the workforce, in particular the workforce system, and I think, for philanthropy as well, there's a really exciting opportunity to use ISAs to really stretch a lot of that funding, to have the same amount of funding, but to have it really benefit more people. We know that the workforce system has more people that want its services than it can provide. And so, I think that, ISAs can be a tool to really kind of like create, a tool on which you can kind of build a more universal system that affects more people. And, you could have some guidance that says, for people that qualify for, free, for free training, then, you can't do an ISA and you have to like push them into kind of this free training. But for people that we weren't previously serving, maybe we could kind of like offer them an ISA. Right. And so you could almost have kind of like for a similar bucket of services, two different kind of financing options, one being free, depending upon the type of student. It's really then important for the counselors, the people who are triaging, the workers that are coming in to just really understand that and make sure that the students are first exhausting all of their other options before going into an ISA. I'd say for the non-Title IV space and for the outside of kind of the formal, federally funded workforce development system, there's not a lot of dollars and there's not a lot of public dollars in it. And we know that employers have been reducing a lot of their investments in workers. So I don't see ISAs potentially displacing any of that. And instead, I see ISAs really being just as filling a gap where there currently is just a real need for for a system that needs to be more affordable and needs to be more accountable.
Great. So I want to shift gears in a second, but I want to get a couple of questions out of the chat as we kind of wrap up, specifically talking about protections for individuals. So there's a question about whether or not there have been ISAs that have taken out some of the protections, including maybe not having to repay under the threshold and perhaps some of the other protections that are in there for people.
I've never seen that. Every single ISA I've seen has that income floor. It's written into the contract, and that's universal as far as I've seen.
What about other protections like the like the number of payments or income levels?
I mean, providers are constantly changing some of their terms because, again, they are kind of figuring out kind of like what this looks like. They're trying to figure out what is financially sustainable. There's been some providers that actually started off with maybe a little less favorable terms, and they made their terms more favorable because they realized that they were making some money, and some of them didn't want to do that, especially if they're kind of more in the nonprofit space. Sure. But I haven't seen, there's definitely never been anyone who has said, well, I previously had an expiration, but now I don't. That wouldn't really be an ISA. The only counterexample I have to that is an interesting one. So in California, the Bureau of Private Post-Secondary Education cracked down on a few ISA schools and forced those schools to not do ISAs within California and instead do what's called a retail installment contract. In those instances, they were forced to change the terms so that the students were actually required to pay back the amount that they financed and maybe more. but they were not able to then offer that downside protection in the same way. And that actually was an example of regulators trying to, I think, pound a square peg into a round hole, and ended up in a situation where they're trying to make the ISA look more like a loan because that's what they were more comfortable with. But in return, it actually ended up with students being worse off. So the only time I've seen protections being actually taken out of ISAs has been at the specific direction of a regulator, and in a way where I think that the regulator was pushing in the wrong direction.
That's fascinating. Oh, talk about unintended consequences.
It's a good example when I was saying of policymakers need to be very intentional about how they do this. I would say that's a good example of not being intentional.
Sure. So that's at the high level, and what you could do to make sure that you are more intentional from a policymaking perspective. On the ground, as we've got career coaches talking to individuals who are weighing their options and have the possibility of an ISA. How are there tools out there to help coaches do better coaching in that space? Is there sort of a comparison of pros and cons of different financing tools? And this is a version of a question we got in the chat.
Yeah, it's a great question. And I think right now, there are many different tools, right? So there's a lot of ISA providers that have kind of interactive tools on their website. So you can kind of model, you can plug in kind of, if I make this much, then how am I going to pay? And then you can kind of compare that to like an equivalent loan or something like that. And then there's also a variety of different disclosure models. So for example, you can have like a table that says kind of, if you make $10,000, make $20,000, et cetera, and you're basically making calculations as to how much, what would your monthly payment be in all of those contingent scenarios. There is no currently kind of like, if you're a career counselor, there is no kind of like one guidance that you can just put in front of the career counselor and you're like, this is the way. Everyone agrees that this is the way to counsel a student. And again, that's just, the industry is relatively new. So that's something that, that we at JFF are still kind of, working on and want to be kind of coalescing the industry around in the future around, what are some counseling best practices for students. But I'd say in addition, I do think that one best practice for ISAs more generally is just really make sure that the student has exhausted, has looked at, is aware of, and maybe exhausted all of their other options. That doesn't mean that ISAs are always the worst option. Oftentimes ISAs are better than Parent Plus loans or Grad Plus loans. Certainly private loans, I think they're oftentimes better than that. They may not be better than federal subsidized loans, and certainly not better than something like Pell Grants. And so I know that, for example, Purdue University, which is one of the largest Title IV providers of ISAs, their counselors make sure they only offer it to people who've exhausted all of their public options. So it's only if you have not, you can't even say like, I know that I could get Pell, I just don't want to, then they just won't give you the ISA. You have to have exhausted all of your other options. That's actually led to Purdue actually having, I think, a smaller uptake on ISAs than they may have thought, but that's purely because that they want to make sure that it's only the students that have exhausted all of their options that even qualify for this.
Great. All the other free options, or the ones
free
that are better for them.
Or even subsidized to federal loans, which are not free, but oftentimes still are advantageous.
So it sounds like we've got another thing to add to the list of things career coaches are going to have to know eventually. Yep. It's a growing list these days. So I want to shift gears and talk for just a few minutes about how ISAs impact a relationship between someone and their employer. And is there a risk that they could exacerbate kind of the power dynamic or imbalance in the employment relationship? I could see some advocates, other stakeholders being a little uneasy about essentially paying workers and then taking those wages back as payment.
Yeah, totally. That also, I share that concern. I had mentioned earlier kind of about employers, declining, reducing a lot of their investments in workers over the last few decades. And I think that looks like that's a pretty kind of like, a pretty consistent trend. And there's a variety of reasons to it. There's kind of like the decline of labor unions, the reduced frictions and search costs, in part because of the rise of better information communications technology like the internet. There is also kind of changes in corporate governance, where the focus more on kind of shareholders above all, rather than a CEO thinking that they have their workers that they also need to be satisfying, in the community, kind of more of a multi-stakeholder approach. So there's a variety of reasons, I think, why investment in workers has gone down. And I do think that ISAs offer a potential to reverse that trend, but I would not do it where a employer is just signing an ISA with their employee for exactly the reasons that you said, that the employment relationship already has a inherent power imbalance. And I just think that it doesn't make sense to layer on top of that something like an ISA. I do think that there's an opportunity for an intermediary to create some sort of kind of regional or sector ISA fund that a lot of employers in the area help capitalize, and that then the workers then, whether maybe they're not even employees of the contributing companies, but that employees are signing then contracts with that fund, which is then at least partially capitalized by the employers. So a good example of this is actually in New Jersey. They've created an ISA fund, or kind of an ISA like fund. It's not exactly an ISA, but and I believe half of the capital is being contributed by the I think the New Jersey Council of CEOs. So there's a variety of different large companies in New Jersey that are contributing to capitalize this fund. And the governor's office is on board with this too. So the state government is contributing some money, and so that's a way where I think that's just exciting. For we always say that, like, look, employers are the ones that ultimately benefit from training, so they should contribute. And maybe this is a way to align those incentives so that this is a way for employers to be able to invest in the local workforce, but not have to worry that they're the ones who invest and then their competitor is the ones that hire. That ultimately they can kind of still see a return on that investment, and then really kind of everyone benefits. Where it can create kind of a virtuous cycle of investment and reinvestment.
That would be fascinating. The coalition has a policy priority to create a flexible supportive service fund, and we're working through how do you finance it. And I could see a scenario where there's some sort of similarities to what you're describing there. Interesting. So we've covered a lot, I think, in a short period of time. I could certainly keep asking questions. We did get those couple questions in the chat, but I'd love to hear if any of the folks in our audience have questions to add. You're welcome to take yourself off, or put yourself on video, take yourself off mute. I let them formulate their questions, and just add one more, because this is, I think, a critically important topic. You mentioned early on that ISAs could be used as a tool to address a racial equity. And could you talk more about that approach and how you see that fitting?
Yeah, certainly. So the impact on racial equity is one that I think that there's a lot of kind of excitement around, but it's all kind of theoretical. So the idea is that basically, and ultimately we won't know the effect until we have empirical data and we're studying it. But the idea is basically that traditional loans underwrite on the basis of individualized history, credit score, past earnings, past employment, et cetera. Or oftentimes on the basis of how much money your parents make, if they're asking your parents to co-sign. By underwriting on the basis of backward-looking kind of individual history, you're kind of inherently taking into account all of the past discrimination that someone might have faced, that both they faced or maybe their family faced. And so there is, and I think there's a real opportunity for ISAs to really improve on this, because ISAs tend not to really care that much about past history. because they're underwriting on the basis of what you're going to do in the future. It's forward-looking underwriting as opposed to backwards-looking underwriting, right? It's purely kind of like the ISA provider is saying, this is a good program, right? We believe that if you enroll in this program, then you are going to have an earnings bump. And so that's the basis on which they're underwriting. And so in some sense, that offers a more like a clean slate. It treats everyone more equally. The other way that can potentially improve racial equity is what I was mentioning kind of about aligning incentives and creating more kind of accountability in the market. Predatory schools, if they are using ISAs, then it's going to be a little more difficult for them because they are getting paid on the basis of their student outcomes. So there is a potential for ISAs, if they are adopted more broadly, for it to raise the overall quality of education, in particular in the non-accredited space, where I think there's a real need for a focus on quality. And we know that the disproportionate number of kind of Black and Hispanic students are victims of a lot of these predatory schools. So if ISAs can, and again that's if, this is just a potential here, but if we can do this the right way, ISAs can then increase the overall quality, and at the very least make it more difficult for the predatory schools to operate, and that itself I think can go a ways towards improving racial equity. There are risks though. I mean, because of the outcomes-based underwriting aspect of it, you could end up in a situation where you're giving better terms to students that the lenders think are going to do better. And that may be whiter students, right? Or students at whiter institutions or in whiter fields of study. So I think it's just really important to be constantly cognizant of this, and for providers in particular to be collecting the data. But one thing I will note is, and in particular for ISA, is if we believe that which I think evidence has shown that there is very much a racial wage gap, and that that white students graduating from the same institution, same field of study, are making more than maybe their Black or Hispanic counterparts. ISAs, if they're all paying ISAs, they're paying a percentage of their income. So it means that then the white students would then end up paying more because they're making more. And so there is a certain element of this idea of paying a percentage of your income embedded in an income share that I think is often can lead to non-white students ending up kind of paying less for the same education. Again, that is kind of like speculation. We need to kind of see that in the data, but I think there's a lot of opportunity there on those fronts to advance racial equity.
Thank you. We talked about this earlier this week. We didn't talk about it today, but one of the things that comes to mind for me is the importance of making sure that our immigrant and refugee population have access to certain tools. And with that, there's also this conversation about undocumented individuals. And is this a tool to reach? I mean, there's some percentage that won't complete the FAFSA because of real fear about what happens then. Is this a tool in that space?
I think it can be, certainly. And one of the more prominent schools that's doing an ISA is the Colorado Mountain College. And they have an ISA fund called Fund Sueños, the Dream Fund. And that is specifically for DACA students, undocumented in the Deferred Action Program. And so that is a way that they have found to offer ISAs to make sure that a lot of these students who otherwise would be shut out from existing from existing educational credit or educational finance are able to are still able to access that. So that's definitely like one way that ISAs are one way that providers have found to kind of close those gaps. Certainly not the only way. I don't want to say that like you have to do ISAs. That's the only way that undocumented students we can expand educational access to them. But so far we're seeing that that's one of the ways that providers are using.
Thank you. I got a question directly about whether or not ISAs fit in any one specific sector better than another. And if you're seeing current ISAs going one direction or into specific occupations, or to support training for specific occupations?
That's a good question. As I mentioned kind of at the outset, the coding boot camps are one industry where ISAs were really um, are really were used kind of early on. And I think part of that was just because there was such confidence in the industry that like, look, we need a lot of coders. So like whatever we can do to kind of bring these students in and get them this education, like we know that it's going to pay off for them. So we're willing to kind of really defer the tuition and make it income contingent. Um, the I think that it can be, viable in really any occupation for any type of skills training. But, it's definitely the case that ISAs work better if the benefit is fairly quick. So, if you have an ISA that only lasts 4 years, and this is one of the challenges kind of with like a bachelor's degree, right? The benefits of bachelor's degree is supposed to last for decades. So, if the ISA is only going 4 or 6 years or something like that, you're really not capturing that, and you then need to charge higher rates in order to compensate. Whereas something like a job where people are, or a skills training where people are getting a job fairly quickly, and it's a job that's paying relatively well over a few years. Those are the types of, I think, situations that are like really well suited for an ISA. Oftentimes that's seen as kind of like the technical fields. I don't think it's necessarily limited to the technical fields though. But ultimately you want, this is really good for training that is, specifically leading to a certain type of job, and that everyone's, the provider is very confident that the jobs will be there, because otherwise they're on the hook.
So I'm not sure that I asked this question specifically enough before. Maybe I just mentioned it as a comment. If there's an ISA that's being established with a training provider, am I correct in saying that they can also include expenses to support, so your typical supportive services, and they could include anything from traditional workforce job readiness services all the way through post-employment career coaching?
Yeah, certainly. And yeah, I think there's a lot of ISA schools that are doing that. And I think it's understandable why, because they have an incentive to do that, right? If they have this financial incentive to make sure that the students earn after they graduate, and if they don't earn, then the school doesn't get repaid, then spending a little bit of extra money on career services to make sure that they actually do get a job,
Right.
actually is like a good financial decision for the school. So ISAs actually create a financial incentive to provide more robust career services in a way that loans oftentimes do not. And so that, I think that's one of kind of the exciting things where you see a lot of these ISA schools, in particular the coding boot camps, where they are almost kind of like half trainer, half staffing agents, staffing and placement agents,
Right.
because it's so important that these students get placed that they're willing to invest a huge amount in the services for them to do so.
Right. And we know that if they get that post-employment coaching, they're so much more likely to advance, which, continues to feed the model. So I want to go off script a little bit because Andrew from Social Finance is on with us and says hello. And it turns out that he is working in Ohio with Jobs Ohio, which is a statewide economic development entity, to set up an ISA fund for Ohio residents. And Andrew, I don't want to put you on the spot, but if there's anything you'd like to share, one of the reasons I did this, or I invited Ethan, is because folks are hearing it out in the field that there's something going on, and what are these ISAs? So if there's anything you'd like to share, please feel free.
Hey there. Well, thank you. Hey, Ethan. I know you've worked with lots of folks from social finance, but we've never actually met. So we, love the topic. We are definitely big believers and agree with Ethan that it's a tool, and it's really how you apply it that makes it a good tool or a bad tool, right? And I think a lot of what we've been doing as social finance is to figure out how do you take the downside protection elements of an ISA, but to apply it to a population that otherwise the counterfactual is they really do not have a pathway to economic mobility. And the work that we're doing with Jobs Ohio, it really is around that. There's sort of two main things that Jobs Ohio cares about, which is how do we really foster innovation within Ohio, right? How do we bring in new types of industry? How do we make sure employers have the employees to be able to grow in Ohio? And two is how do you access the workforce, that set of sort of under-skilled or underemployed populations, and be able to provide them with reasonable financing terms, right? So they have been standing up some pilots in the Cleveland area in particular, and we've been working with them over the past 4 or 5 months to really expand this program across the state. And as Ethan mentioned, there are lots of sort of career pathways that are particularly suitable. Coding bootcamp is one, but we've also been working a lot with some skill trades because parts of the states need Industry 4.0, right? And trying to find those providers that can enable that pathway is some of the work that we've been working on. So I will drop the Jobs Ohio contact into the chat, and maybe folks are interested in sort of reaching out to them and diving deeply into what is it that they're trying to accomplish. You should reach out to them.
Thank you. I mean, I think it's a great time to be talking about what other supports we can include with that. So thank you very much for jumping on. I definitely put you on the spot. It's nice to meet you. And I know John, so great. I will reach out to him. So we have used up our time. We have 1 minute left. I want to take that opportunity to thank Ethan for joining us today and sharing this knowledge. I was teasing him saying earlier this week going, how do you get to like specifically focus on this? But I have a better understanding of how now, because there's a lot to talk about and a lot to understand. You can share this conversation with your colleagues by clicking on the link to the recording on the Ohio Workforce Coalition's website, which is just ohioworkforcecoalition.org. We usually also distribute that link with the follow-up survey. And please join us next month when our webinar falls during National Family Literacy Week to talk more about strategies to advance family literacy, which in some way, shape, or form probably is connected to an ISA somewhere. So, Ethan, any parting comments?
I'm just super happy that everyone's interested in this issue, and just to underline the message that both I and kind of Andrew had said before is that ISAs are not a panacea. They're not the thing that will fix everything. They're a tool. They're a powerful tool. They do have risks. So let's make sure that we deploy them in the right way.
Thank you. Wonderful. And thank you for joining. We will see you next month.